You know, when you look at a company like Bank of America, I mean, it's a true giant of the financial world. You've got to wonder, what makes it so dominant? How does it stay on top year after year, fending off all these competitors? Well, we're going to dive right into that because the answer lies in this really powerful concept that, believe it or not, protects it just like a medieval castle.
And that concept is what we call an economic moat. It's a great analogy, right? Just like a moat protects a castle from attackers, an economic moat is this set of advantages that protects a company's profits and market share from its rivals. It's the secret sauce to a business's staying power. So, to get a little more formal about it, an economic moat is a company's structural ability to keep competitors at arm's length. And this isn't just about being big, it's about having specific, really durable advantages. Think about things like having the absolute lowest cost in your industry, or making it a huge pain for your customers to even think about switching to someone else. Okay, so what exactly makes up Bank of America's fortress? What are the building blocks of its incredibly powerful, wide economic moat? Let's break it down, and we'll start with the most obvious advantage of them all. It all starts with just sheer, undeniable scale. Bank of America isn't just a big bank, it's one of the absolute top financial franchises in the entire country. Its size alone creates this massive barrier to entry for anyone trying to compete. So, just how big are we talking here?
Let's put some numbers on this to give you an idea. As of the latest reports, the bank had about $3.3 trillion in assets. It's an almost incomprehensible amount of financial power, really.
And get this, it serves a staggering 60 million clients. That is a massive customer base that gives them incredible stability, not to mention a deep well of data and relationships to draw from.
And to top it all off, it's also a top 4 credit card issuer in the US. So you see, this isn't just strength in one area, it's dominance across multiple, absolutely critical parts of the financial world. But, size is only part of the story.
Because that huge scale enables something even more powerful. The true heart of Bank of America's fortress, its secret weapon if you will, is an incredibly cheap source of funding, its massive base of consumer deposits. This number right here is just stunning. In its latest reports, Bank of America was paying just 0.64% in interest on its consumer deposits. So why would millions of people accept such a low rate? Well, it boils down to a powerful mix of convenience, trust, and frankly, the sheer hassle of moving your main bank account.
Now, to really put that in perspective, at the same time the bank was paying just over 0.5%, the benchmark federal funds rate was 4.33%. That enormous gap, that difference between what it pays for money and what it can earn by lending it out, is a huge built-in source of profitability. It's a money-making machine.
And this cheap funding doesn't just support one little part of the business, it fuels the entire empire. We're talking consumer banking, its global wealth division with Merrill Lynch, its global banking operations for huge corporations, and its global markets trading desk. The parts really do make the whole stronger.
But hey, no fortress is perfect, right? Every investment story has two sides. So, what are the arguments for and against the bank's continued dominance? Let's take a look at the debate between the bulls and the bears.
Okay, so the bulls think the story only gets better from here. They argue that if Bank of America keeps snatching up more market share in those super important retail deposits, its profits could just soar even higher. The bears, on the other hand, they're pointing to a potential weakness. They're worried that the bank is holding a big portfolio of long-term bonds that it bought back when interest rates were really low. Now, if rates fall, the bank could be stuck earning tiny returns on those old investments, and that could drag down profits for years.
So, we've got the strengths, we've got the potential risks. How does an analyst take all of that, weigh it, and decide what the company is actually worth? Let's see how this all translates into a final valuation.
After crunching all the numbers, the verdict from the analyst is that the company is fairly valued. Basically, this just means the stock's current price is trading really close to what the analyst estimates its intrinsic worth or its fair value ought to be. So, what's that magic number we're talking about? The analyst pegs the fair value estimate at exactly $51 per share. That's the anchor point for this whole valuation discussion.
And here you can see that comparison side by side. With the last price at $51.48 and that $51 fair value estimate, well, they're practically on top of each other. This is pretty much the textbook definition of a stock that's considered fairly valued.
All right, finally, let's look ahead a little. Because the biggest force that's reshaping the entire banking world and the future of Bank of America's fortress is the relentless march of technology.
You know, this quote from the source material really just nails the whole dynamic. In an era where tech is everything, having the scale, the sheer size to fund massive tech budgets is a gigantic advantage. As the industry consolidates, firms like Bank of America that can actually afford to keep up in this technology arms race are really seen as the long-term winners.
And that brings us to our final thought here. The very nature of a bank's moat is changing. It's not just about branches and balance sheets anymore. It's about digital platforms, it's about data analytics, it's about AI. So as technology continues to just completely remake the financial world, the big question is, which of today's fortresses are truly built to last?